Hi, my name is Dylan Lewis and I'm an analyst here at The Motley Fool. We've been helping regular folks learn how to invest for over 2 decades. And frankly, it's a lot simpler than most people try to make it out to be. I'm not going to pitch you on some get-rich-quick scheme or tell you to hand your money over to some overpaid Wall Street banker. Learning how to invest to build your wealth doesn't have to take a bunch of time, experience, or money. In fact, we have 5 key steps to put people on the path to beginning their investing journey, even if they're coming at it with no experience whatsoever. I'm going to talk about that in just a minute. Before we get started though, one question we get here a lot is, how much money do I need to have to start investing? And I'm going to tell you, it's not nearly as much as you think. With the rise of commission-free brokerages, you can get started with just maybe $100 and then slowly add to that with each paycheck. With that in mind, we're going to talk through these 5 principles of investing that can get you on the path to wealth and financial freedom. If you have any questions or thoughts as I talk through this, put them in the comments section below. Also, we'd love to know, why do you want to learn how to invest? Is it money for vacations, maybe building up a retirement nest egg, possibly putting your kids through college? If you let us know, we'll make sure to put those topics into videos in the future. All right, let's talk about those 5 key principles. Number 1, take control. Before you start putting money to work for you, you need to make sure you're in a good financial position to handle whatever life may throw at you. Otherwise, you may begin your investing journey only to have your plans derailed because someone sideswiped you on the highway and now you have to pay for damage to your car. So before you can really start investing, you have to have some separate cash in the bank for emergencies. Preferably something like 6 months of your non-negotiable expenses. What I mean by that is the stuff you can't change. Car payments, rent, your mortgage amount, stuff like that. But you can never walk away from car debt without actually losing your car. And of course, you actually need to have a roof over your head. Once you have that cushion, you'll be able to handle any major expenses that may come along without going into debt. And then after that, you have the money saved, you can take your next few $100 and start investing. Principle number 2, play the long game. Investing is a marathon, not a sprint. And if you do things right, it's really more like a Netflix marathon than an actual marathon. One of the biggest investing mistakes I see people make is having a great idea and then pocketing their profits too soon. Great investing ideas can take a long time to fully play out. Consider Amazon stock, which has increased over 50,000% since its IPO in 1997. Meaning every dollar you invested in Amazon would be worth over $500 today. Think about that for a second. $10,000 invested then would be worth over $5 million today. Now compare that to if you had sold your winner earlier. If you'd sold shares after about a year, you'd been up 281%. At 5 years, 918%. At 10 years, 2,993%. At 15 years, 11,358%. You get the idea. In each of those cases, you'd have made money. After a year, you would have turned your $10,000 over to $30,000. It's nothing to sneeze at, but it's a far cry from the returns that investors that earned by simply not selling the stock. And with that in mind, when you look at the Amazon chart, things have generally looked pretty good. But the stock has also lost significant value at times. From April 12, 1999 to February 28, 2001, Amazon stock lost almost 90% of its value. Of course, it regained most of it, and then some in the following years, but you had to hang on through the good times and the bad. My point here is simple. If you have a great idea, hold on to it and let it keep making you wealthier while you do other things with your time. Here at The Motley Fool, we call this buy and hold investing. We look for quality companies built for the long term and don't spend too much time sweating the day-to-day swings. We're going to move on over to principle number 3, but before we do, if you're enjoying this video, take a second and like it down below and you can subscribe to our channel. That way you'll get updates from all the other stuff that we post. Principle number 3, understanding risk. Too many investors spend so much time afraid of actually losing money that they try to completely avoid risk, which means they don't make any money. As a case in point, check your savings account. What kind of yield are you getting? 0.25% annually? Are you one of the lucky few maybe getting 1% annually? You're still losing out to inflation. Stocks have historically returned over 6% each year after accounting for inflation. The reason for the better returns? Stocks are riskier. But that average includes the Great Depression and the Great Recession of 2008-2009, and every other market panic and collapse in between. These events underscore the importance of playing the long game, by the way. By obeying the principle I'm discussing here over long time horizons, you can make a lot more than you lose. Of course, if you invest in the stock market, you're also going to lose money sometimes. I own 2 stocks that are currently down over 50%, but overall my portfolio is up, and it's doing way better than if I just held that money as cash. And that's all because of principle number 4. Spread your bets. You know how they say don't put all your eggs in one basket? Well, that is particularly true when it comes to investing. As a beginner, you can't just immediately be able to identify great companies. Like most things, learning how to invest in stocks takes time. It's a skill that needs to be developed. So rather than buy individual stocks, what most new investors should do is start by investing in the broader stock market. Fortunately, there are funds designed to do just that. They bundle a bunch of stocks together so you don't have to buy shares in each. You can instead buy shares in the fund, which will give you automatic exposure to the big parts of the stock market. Of course, all funds are not created equal, which is why you have to focus on the fifth key principle of investing, and that's pay less. If someone buys a nice shirt for 50 bucks and you can buy the exact same shirt off a discount rack for 20 bucks, why wouldn't you? Pocket the money, right? The same is true in investing. There are more expensive ways to do things and cheaper ways to do the same thing. Let's talk about passive indexing. What that means is investing in funds that track the market indices, funds that try to mimic the S&P 500 or the Russell 2000. It's a low-cost way to get broad exposure to the market. That's because index funds charge very low fees. In fact, Vanguard offers an S&P 500 index fund that has a 0.14% annual fee. So investing $3,000 in it would only cost you $4 per year. The average for comparable funds, by the way, those shirts on the expensive rack, was over 1%. That may not sound like a big difference, but over a long period of time, it can work out to some serious cash. Let's say you put $3,000 per year into the Vanguard fund and $3,000 per year into a comparable fund with an annual fee that is 1 percentage point higher, so 1.14%. You can do this for 30 years, during which time the stock market returns 6%. In the high fee fund, you're doing pretty well. You have over $201,000 after 30 years. But in the Vanguard fund, you're doing even better, with over $244,000. That's a $43,000 difference, some serious cash. And the reason? Fees. And it's the fees you're paying Wall Street. That figure right there is why we think individuals ought to take charge of their financial lives. If you're still watching, you're well on your way to doing just that. So to recap, I've talked about the 5 key principles that give you the mindset and the space to invest well. These underlying principles will help you start out investing. There's a lot more to learn before you're ready to buy individual stocks. So if you're ready to take the next step and learn how to pick great stocks, watch this video next. But before you head over there, like this video and subscribe to our channel so you don't miss out on future videos from our team. And of course, if you have any questions or comments, drop them in the comments section and we'll do our best to answer them down the road. Thanks for watching, and Fool on.